Okay. Everybody have a good Halloween?
Yes.
Many trick-or-treaters at your house?
No, they don't.
They don't come to my house. We just don't have many in our neighborhood at all. There's some young families down the street, but they must go elsewhere. So.
Ours all go into one of the development areas that makes more sense.
Yep. Yeah, when we used to live in a development area, they came in droves. So a lot of people we didn't recognize. And then they never liked to come to my house because if I felt they were too old and they'd say trick or treat, I'd say trick.
Except for you.
Well, I had people building pyramids and singing Christmas carols and various stunts and somersaults and stuff in my front yard. So
cool.
Then the kids all of a sudden would have something planned. They're like, we knew you were going to ask this year. We had something planned.
They knew your house. Huh?
Yeah. I was the old mean guy. I'm the old guy on the corner. All right, we're going to get that guy. We never ragged or teepeed, so that was always good. But so. Okay, so you had a question on, Marianne, let's see, you were having trouble with 6, the Fowlers?
Fowler.
Okay.
It's only on the state. The federal I was correct on where they owed.
Okay. And then they owed on the state as well.
Okay, so no, I have a refund.
Okay.
That was the whole thing. They will like me. That was it.
Okay.
So not off.
All right, and let's see, did you check your state withholding? Make sure you're correct.
Okay, so I would check that on my main, no, my W.
Yep, double check your W-2s.
Make sure that I put them in there.
Yep.
My state is in on that one. Oh my goodness. My state is in on that one. Yeah.
So 2589 was the withholding on the
Computer guy?
Yep.
Yep, 2589, and on my donut lady, 3741.
Okay. All right. Did you give them any? You didn't give them any credits for the education, correct?
Education.
The IT 272.
IT 272. I have a question mark on one. So I never. Oh, I guess I never finished filling that out.
Okay, but you don't because it's undergraduate, or they're both in graduate school, and the credit on the state. Okay. Well, let's go through.
Oh, that's why though, because that one actually at the bottom says refund.
Okay. Well, let's go through it and see what we have. Put it together real quick. It's no problem.
Okay, maybe I have to write no on it. Does this taxpayer also qualify for New York State college tuition credit or itemized deduction? I never answered that no. So that's right. No. I'm still 1135 to do.
Let's see where they're at
Is the student claimed as a payment?
Okay, so we have. Okay, so let's just put it in and we'll see where we're at. And doesn't mean the answer key is always right. You got the money and they don't owe money, I'm sure they're going to like you.
I'm very out of it. Money, a lot of money from the state and the old federal, isn't it?
No, not necessarily. It depends how they do their withholding. Sometimes people don't really focus on their state withholding like they should. They just kind of give up to the fact that they're always going to owe New York State money. So it doesn't really.
You really mean.
Mm-hmm.
I'll do it right now, make sure that I can see what you did.
Okay. It was Julie's birthday yesterday. Do you remember to give her the birthday credit? Do your taxes on your birthday that you get a special credit in New York?
No, they don't, do they?
No dependents.
Everybody's birthday is April 15th.
Yeah. Everybody would be changing their birthday.
marriage filing jointly, correct?
That's correct. You have married filing joint.
Even New York TR 579 is already blue. I know you didn't go into it yet.
Let's see, they 1040A, so they did not itemize last year. Okay. And they had health insurance all year long. It doesn't affect the state, so there's not an issue there, but we'll clean that up. Okay, and we'll have the W-2s for them. Okay. And maybe we had his. Right. Here did have a contribution to retirement.
This is 35, okay. I know
Mhm.
that.
Right. And we check holding. Make one up for. Oops, that first one was the spouse, wasn't it? Oops, I forgot to put Julie's social security number in there. And this one is for Bob.
Rhonda?
Mm-hmm.
I think Julia's is. Oh, she is, yeah.
Oh, this is the spouse one. This is computers are us as Bob, right? Okay. And she works at Donuts Unlimited. Am I right on that? She's the office manager. You don't know how big Donuts Unlimited are. They're unlimited. Contributions to the retirement. Always make sure that they do. You check that retirement plan. We're in New York. And okay, so we had that, and that. Okay, and then they each had an education credit. All right, we have this for 8863. Mm-hmm. She attended University of your state. Earning EIN number for them. Okay. And she's in graduate school, so this one we're going to say hit yes on that. So we're going to go down and put it in there for her, the 3,300, because she's in grad school.
I put 3,300 on the bottom, right?
Okay. And then we have one for Bob. And he was he also went to the university.
Number 4, I didn't put anything in. Enter the institution.
Okay. All right, so I have that.
Okay, on number 4 on that B, it says enter the institution for claiming the American Opportunity Credit. Or if you answer
Which one?
yes, 2 or 3. Okay, that answer.
Yeah. That's the EIN number. So our New York 272, they are dependents, but it was not for undergraduates. So we don't have anything on that New York 272. So looking at what I have, I would say yes, that they have a refund of $1135.
So that means the key was wrong?
Mm-hmm.
Thank you.
Where'd it go?
Can you put that in there?
So yes, I would correct your answer key on that one, that there's a refund on the state side.
1135.
Mm-hmm. Mm-hmm.
Okay. So they are getting a refund back, but yet we have to pay credit.
Mm-hmm. And that's not uncommon. That is not uncommon at all. Okay. Okay. How do we do on the problems in 7? Anything get you there? We had Gina Daniels.
Oh, those problems. Okay, that's something.
Yeah, no, I'm sorry, the workbook problems while we're in there.
All right. Well, one we went over together.
Yeah, Jean's pretty straightforward. She's probably got, she looks like she's had a household. There's a 1040A. She had W-2. So some earned income credit there for her. Greg Fellows, the only thing that was in that one was a,
Okay, wait, Gina Daniels, what did you get for?
what's that?
Can you know the answer to that?
Gina Daniels. The federal would have been a refund of $48.86
Okay.
and the state refund of $16.72. And then we had Greg Fellows, and the only bullet point that jumped out there was the fact that Greg replaced his furnace at a cost of $27.35.
Yeah. But we didn't get him to get anything for it.
Why is that?
Oh.
Okay. Is income and credit there. Okay. Well, it's one of those credits was his tax liability because of his income. His income's pretty low at $19,000,
Right, that's like a-
and he had the dependent care credit. So it may have been the case that
Was it a carry forward? You could do it
for the
energy credit?
no, because it probably just wiped it out because he probably had more credits than he needed because his tax liability was so low. What was his tax liability?
I'll see, I end up with a surplus on him.
But what I'm saying, if you look at page 2 of his 1040,
1040, page 2.
mm-hmm.
Okay.
Take a look at that one and see, you know, what was the part where non-refundable, where the energy credit. Does he have a tax bill?
No.
See, I had a tax bill of 209.
So after the non-refundable, was there a zero there?
On 56, you mean?
On 56?
Yeah.
56 is zero.
Okay, so the credit, so probably his dependent or childcare credit ate it up, so he didn't get to take the energy credit because he didn't need it.
That's fine.
Yep, because it's a
We got
non-refundable.
150.
Yep,
Correct.
but it was non-refundable credit, so there wasn't enough of a tax bill for the need for it.
So it won't even show that on
It'll show on the sheet that you do when you do the energy credit work or form, but it will not show up on the 1040 because he did not need it.
it. All right, so yes, I have it showing 150, but then when it goes over, it's zero.
And that's where, we spend that time, really distinguishing between non-refundable and refundable. Those non-refundable, in the pecking order that they would go in there, they are used up, to try to eat up the tax bill, especially like the child tax credit. It has a refundable portion for the additional child tax credit. So it'll be the last one to be used. So.
And the computer will automatically do it that way.
Mm-hmm. Mm-hmm. Yep.
Does that be carried forward to next year?
No, you can use it for 5 years.
So can he try to apply again?
What's that?
Can he try to apply for it again next year?
But he didn't purchase furnace in that year.
Yeah, we didn't, okay, so next year, if he purchased something else, he could, but for this.
Yeah, like I said, the energy credit has gotten very, very narrow, and it's a 9 lives. Every year it disappears, and then all of a sudden, December 31st, somebody's lobbyist is strong enough to put it back in. So,
That's answered it.
yep. So that's where that one gets in there.
So what's the answer
Yeah,
to
what would
fellow?
the refund of the state?
Did I type it? Did it?
Let's see, fellows, we had a federal refund of $57.04 and a state refund of $26.57.
Yep.
Okay. All right.
That's the only question I got. Because of the other ones, we did Randall together.
But that's just personal to my daughter's new door she wants. If she can go back and amend it, they put a new door,
Mm-hmm.
exterior door,
Mm-hmm.
so she can go back, she didn't claim it last year, she can amend and
Yes.
claim it.
And it might be 150,
Yeah.
dollars or whatever. I mean, it might be pretty minimal, but it's $150 towards the door.
Yeah.
So,
Yeah.
all right.
Had a baby, so they need.
A lot of diapers. All right, so that was fellows. Randall, we did, correct? So that covers all 3 of those. All right. Jim had asked last week, I come bearing gifts again. This is a
Thank
little
you
sheet.
for, I used the school code thing, that makes,
Makes it a lot easier to have that one
Yeah.
don't have to look around.
This is some little highlights for the 18. You had asked the difference on the rates. This is the thing I did that has the rates,
Okay.
the table for the rates on it too. And then the last one is just a little thing that we came up with. We started doing. It's a little organizer type thing to have in your records, tax organizer sheet
Oh, nice.
that we do.
But you were asking Jim about the tables and the comparisons of the differences and stuff. So it kind of shows you 17 and 18 side by side. So you can see where the rates change, and you can see the sometimes the ranges of the taxes change. Let me grab my copy here. So, if you look there, like you look in 17 on the single person, some things change just a little bit. As you get to the middle with the new taxes, some of the ranges, especially when you get to that 32 and 35%, that's really not that big a change from 17, but you can see how the ranges that those taxes apply to has changed. So, all right. So really, if you look at it, people that are in excess of 200,000 really, in essence, are paying probably a little bit more tax if they're in that $200,000 to $300,000 to $400,000 range, Because you can see if you look on the left, 33% on 2017 for a single person was 191 to 416. It is now 32% drops to 157 and only goes up to 200. And then
Which
200,
page are you looking at?
this one right here, the tax
That one on the first.
on the front side, yep, for single person.
Single person.
Yep, but you can kind of see how they're in the, see how the rates and the ranges have changed.
Yeah.
So yes, and you know, so the tax rates have dropped. You know, the 12, 24, 12, 22, 24 is versus 15, 25, 28. But you get up in that 30+%, a lot more people.
Gotta be in there, right?
Exactly. And you know, people over 200,000, their income's good chance is going to be taxed now at 35 instead of 33 from the previous year. So, you know, that's where when you start to pick apart the tax law, you know, you see things, you're thinking,
That's why I think what he was trying to design it for was the lower class, the lower middle class, to help them
Mhm.
more so than the ones making the bigger bucks. They have more cushion.
yeah,
That's
exactly.
where it seems like what he was trying to gear to is that people don't feel so stressed.
Yeah, exactly.
The other
Exactly.
ones I can feel stressed. Yeah, they may pay 200 more. But the lower ones, they need 200 more than a lot.
Yes.
That's how I feel. He was trying to do.
Yep. $1,000 to somebody that makes 80,000 is a lot more money than $1,000 to somebody that makes 200,000. You know, so that's a big difference.
Right.
You know, and
So, I think that's what he was trying to gear it for those.
well, and two, you know, even though he's, you know, there's a lot of changes with that tax, like we talked about with 2018 for the child tax credit. Well, now we're raising that child tax credit up to 400,000 that people can keep it.
Right. So
Well,
that helps them get to that more.
yep. So that may offset some of the increase of the tax liability. Chances are those people may have other things that will allow them to still itemize, but again, with the SALT limited at 10,000, you know, they probably have property taxes and state tax withholding that
They're probably 15 to 20 cents in property taxes, especially. these
Alone.
others, like,
Yeah.
20,
alone. So
Alone, so.
yeah, so it's
Flooding, so I mean,
yeah, it's hard. You know, we've tried to on the radio and stuff, and Esther's really tried hard to get people to understand the impact, because you know, when everybody hears tax cuts and you know they heard about all this stuff, and everybody I think has this image that they're going to come to do their tax return and have a much bigger refund. You know,
yeah.
80% of people.
You might have withheld less to begin with. So
Yep, 80% of people already got their tax break before they even filed because it was in the withholding in their paycheck. Their refund, depending on things that are on their return and where they're at in life with family or whatever, they might not see much of a change as far as their refund. It might decrease a little bit because they got a portion of their refund increase in their paycheck. So it's going to be a very interesting filing season. So
Yeah.
it,
That's why I'd like to file it as 217 and then refile it at 218.
to see what happened.
Yes.
Just yeah.
Yeah, see how things fall.
Don't worry, I don't want you to send me people that are gonna get nice refunds, so they don't get mad at me.
You want us to screen your appointment, Jim?
Yeah.
Excuse me, can I just have your numbers? I'm gonna do a preliminary for you. Well, I'm gonna send you over to Mary Ann.
Yeah.
She's much better at this return than I am.
She'll give you the news.
Yeah. So,
I just watched it more.
all right. Okay, so we have, we did that. We got through the problems. We'll do some more today. Let's see here. Let's go to Chapter 7 was our non-refundable Part 2. Did we have anything that jumped out us in the exercises? A lot of those were pretty straightforward. You know, the one with 7A was talking about the test for the qualifying child. 7C, well, 7B was talking about doing the little child tax credit. And again, you know, the biggest thing I want you to walk away from when you do these, the longhand exercises in the textbook is seeing how the calculation takes place and how it may be limited, both phase out depending on their income. And again, because it's a non-refundable tax credit, we have to kind of understand you know, they may not get the full credit because it may have already consumed, like we ran into with the energy credit, may have already consumed their tax bill. So we got to make sure that, you know, those are the good things where the forms and, you know, again, too, with some of this, you get the one 7B where you get, and you got the stop sign. Because all of a sudden you get to a point where it says, you know, is the amount on line 1 more than the amount on line 5? And what does it say? Stop. You don't get it. Do not pass go. Do not collect your child tax credit. Okay. Let's see. 7C talked about adoption expenses. Okay. Qualifying and non-qualifying. Again, that was just to make sure you understand when somebody applies for that adoption credit that you know what those credits would be. Okay. All right. Some longhand on the forms. We did some 8839s. A lot of it was just, you know, kind of rehashing some of the things on where the forms and such worked, and how it consumed things and how the credit would work for you, especially had one where you probably didn't use the entire adoption credit so that you realize that that credit does carry over, okay? And, you know, again, very good credit, obviously a lot of money, $13,570, but again, you know, it's not a credit that's going to raise that child for the entire time that you have them. So,
That's what I had a question on.
yes.
Okay, I put in, okay, part 3, additional child tax credit.
Which exercise?
B, 7B. Are we still on
Okay.
7B or did
Sure.
we do that?
Yep. Sure.
I didn't
Yep.
do that.
Okay.
For number 1, on part 1, on number 2, I put 96,241. Is that the correct figure to put on?
On the, which one are you doing? The additional child tax
It's
credits?
Child tax credit 7B, part 1.
Mhm. Question 2, or I mean, line.
Part 1, number 2, question 2 is enter the amount from 1040, line 38. So
Mhm.
96,241.
Yes.
Okay. Then on the following page for the child tax credit, part 2, the additional child tax credit,
Mm-hmm.
I have for 4A also 96,241.
Let's see, earned income, see separate instructions.
And then I looked in the answer key to see if I did this correctly, because I'll do it, then check to see what I'm doing wrong. And it did not have a figure on it.
Well, they just had, again, it's a difference between 38 is what on your tax form. 37, 38 are your adjusted gross income. What does it ask for there on line 4A on part 2 for the additional child tax? Earned income. So if I look at their return, let's see, this is for the boys, correct?
Right, and then we'll go back. That's pretty.
Their earned income, let's see, oops, I don't have the here. Let me see. Probably something in there. Doo-doo.
An underlying earned income.
Mm-hmm.
And where do you find that earned income again? What number?
You really don't find it.
I didn't think so. You find it on that sheet that you do the EIC on the
Mhm.
left-hand side. But I don't think we put the void in and got all that far on that.
Yeah, they must have something in there that was unearned income.
Okay. Threw a little wrench in.
Yeah, just looking at the description on their problems here.
We did all along here.
Yeah, there must have been something in their income that had them limited, because that's where they probably had it. There must have been like interest income or something like that.
Okay.
Is probably what was taken back into. That's where that 90,500 comes from.
Okay.
Okay, because yeah, that's where you have to do the earned income on that, because that additional child tax credit, you know, just like the earned income credit, a lot of the refundable credits, you know, are based a little bit different. So where they're based on an earned income as opposed to an adjusted gross income.
Now, would this automatically be filled out in the computer again?
Yes.
So, okay.
Yeah, because it would know. We don't have 1040 page one here anywhere. So, but if we saw that in that income section on the front of the top of page one, the first section, yeah, 7 through 21, there must be some unearned income in there in some form. So, okay. All right. So let's hit the, let's see here. That is that. So let's go take care of the quiz on chapter 7. And we got that, so let's get that up on the screen. Okay. All right, so we're on page 766. We have our quiz. Jim, you want to do number 1 for me?
Sure. Which of the following is false regarding retirement savings contributions credit? C, the person who made the qualifying contribution was born after January 1st, 2000.
Yeah, exactly. Okay. All right. Marianne, number 2.
Which of the following is a requirement for a qualifying child for purposes of the child tax credit? B, the child must be claimed as a taxpayer's pet.
Yep. And that's the one too. I emphasize on the fact that if, there's a situation where, there's an 8332 releasing that exemption, okay, that non-custodial or non-residential parent, what you're passing is the child tax credit and the exemption, because where does that child become a dependent? Yeah, the person you pass. That's what you're passing to them. All right. We had the discussion, the problem the other night, or Tuesday night. One of the ones I had them doing the extra one had the instance where mom had low income, was claiming the child as she should, has had a household. She was divorced, and she is the custodial parent. So she was getting the earned income credit because she met all the criteria for that. However, she was releasing to dad the exemption and the child tax credit. So that was their agreement, and you'll see that a lot of times where sometimes the parents will be able to alternate each year. But mom being head of household, custodial parent, she still could get the earned income credit. Okay? And the way that you do that, you have to, on the main info sheet, she still had a household. The child's listed, is with her 12 months, but for the dependent where it says, did they live with you? You have to put 0. So that takes off the child tax credit and takes off the exemption because they were non-dependent. It's not her dependent any longer. It's only hers for the earned income credit.
So it doesn't affect the amount of earned income credit she's going to get because her income's low?
Mm-hmm.
So
it's kind of beneficial to both houses. And, and in the divorce decree, dad got the chance every other year to get the exemption and the child tax credit. He does not get to file head of household. He is still single because he does not meet the residential test for head of household, but he's single, but he does, and sometimes you see it where, maybe mom was a stay-at-home and she has the kids. Now she's back in the workforce and she has a lower income job, and dad had always been working as a manager at obviously the Donuts Unlimited, making $58,000. He's going to get more out of the exemption and the child tax credit than she is because she may not need it because she'll have no tax bill.
So he's single with a dependent.
Yep. That does not live with him. Yep. Yep.
And
So
simply because of the decree that
mm-hmm.
I can do that.
Yep. Yep. And that's one, like I said, but you have to be real careful when you do it for 2 reasons. You can't allow somebody to double dip on something. And the other thing is you don't want to make it look like that child's social security number shows up on 2 returns, because then you create a conflict in the system.
But it will show up. Because she's
Not
taking
necessarily.
something and he's taking something.
Let me show you. Let me kind of show you on this one.
Yeah.
Okay.
Where do you want us to go?
I'm just going to kind of go, let me see if I have one of a single parent. I'm going to go to Sarah. Did she have earned income credit? She did. Okay. So I have Sarah Day open, okay, up on the board there. Sarah is a maid. She's had a household with her daughter Melinda, okay? So if you look right here on the screen, I'm in that main info sheet, and I'm where dependents and non-dependents show up, okay? So I'm going across here, she's in the home, but on this one, she is a non-dependent because I have passed that dependent onto, all right, onto the husband, okay? So now that's gone. So if you look, it didn't hurt her too bad because she still has a very small tax bill at $26, okay? She's still receiving her earned income credit, but she did lose money because of the not having, you see here, there's no child tax credit because she gave that to her ex-husband.
So what is her bottom line? What's her refund?
Her refund is $39.41.
So she lost $1,000.
Mm-hmm. What did she lose? Child tax credit. She gave that to, and that was the agreement in the divorce. Okay? So, and that's why sometimes you see that it's in that divorce or separation decree that they alternate years because, you know, she doesn't want to lose $1,000 every year, but she's willing in the settlement to give $1,000. What's that?
What did she lose on estate?
She's at $1,330 or $1,399.
$400, that's $1,400.
Yep.
You gotta cover both.
Mm-hmm. So, but again, that's the way the divorce decree would work.
She didn't
Okay?
feel benevolent. She.
Yep. But she did not pass the earned income credit because the person on the other return cannot do that because they didn't pass the test where the residents.
The child did not live.
Yep, exactly. Okay. So yeah, so that's the way that, you know, that works on that because she can still had a household with that. And you can see as soon as I took that one out of there, that calculated child tax credit disappeared, but now it's back. Okay. And obviously that makes her refund go up considerably because she now has no tax bill. Okay. Because she got the exemption back, so she didn't even have to worry about that. And the $1,000 comes right to the bottom for her for the additional child tax credit because she has that. And, you know, again, now for 2018, a little bit more money on the table because now it's $1,400. $2,000 of a non-refundable, $1,400 of it can be refundable. So that's one of the things that's in that one little cheat sheet I gave you. So, you know, when you have that, it puts a lot more on the table.
So she could lose a lot more now.
Exactly. Mm-hmm. Yep. So on this one, she would have lost probably an additional $400. Okay. All right. Okay. So that's kind of what that one is. All right. So that's why this CTC one is important. Okay. Where are we at? Number 3, Jim.
Which statement is false concerning a qualifying child that allows the child to be claimed for the child tax credit? C, the child provided at least half percent.
Mm-hmm. Mm-hmm. Okay.
Which statement is false regarding residential energy credits? D, the non-business energy property credit is available for both new and existing homes.
Yeah. There's, when we get in, I'll try to bring some of the stuff in. This is a thing, this statement about new and existing and stuff like that. There's a lot of things that have changed as far as depreciation, where things used to, for special elections and things like that, it used to have to be new. But now you can do used cars, and I'll show you how that one works for 18. That's one of the things that's changed. There's some stuff with depreciation rules that have really changed for 18. Okay. All right, Jim, number 5.
This is one of the few credits the filing status married filing separately can claim. C, child tax credit.
Yep, which is great. Okay. You know, again, because the situations, it may be just such that they cannot do a joint return or wherever it is. And it would be a shame that it would hurt the child that credit's not there. You would hope that extra $1,000, whatever household it goes to, would be used for the child, but that would be the benefit for it. So, okay.
But if you look at the thing that's going to do it, the married filing separately, they don't divide that one in half for each one.
No.
Only one can take it.
Well, it's a credit that follows the dependent and how many
But if the
return.
dependent is in that household, that means that one filing separately has to take that one as a dependent and then can use it.
Yes.
Which means the other one's not having it on it, even though they're living in the same household.
So, yeah, and that's where, you have to weigh that when you're doing things. I think I've talked about the fact that we see a lot of married filing separate, same households in this day and age because one or the other has a lot of student loan debt. And in order to have lower income for the income adjustment on their student loan payments, they have to do married filing separate. And we always have to weigh it for them because sometimes the loss on the tax return is greater than the savings on the student loans, but that's very rare. Most of the time, for what they get doing married filing separate to save on their student loans is far greater than what they lose on their tax return.
Is that loan adjustment just the payment amount, not what they owe?
It depends how they negotiate it. I don't do a lot. I defer all those questions to somebody that we team with over at the financial guys. That's a college planner, and or that has a little bit more experience with student loans and how that reduction works. But I always have them double check because I will present both sides to them, and they know if they turned in the tax return married filing joint to their student loan, what their payments would be. And the student loan people say, well, if you did married filing separate, this is what your payment would be. So, and like I said, most time the savings on student loans is far greater than the loss of married filing separate. Okay.
So then you definitely want to do married filing separate.
For student loans, most of the time, yes. Yep. But there are times, like I said, when I had one that we looked at it with an adoption credit on it, the credit plus the carry forward was far greater than what they were saving on their student loans. But yet they were at a point that they were very late in the student loan payoff, so it did not hurt them. Somebody's early on probably doesn't work as well. Adoption credit's not going to help them as much. So it so happened that they were such with their student loans and late in the process and almost paying them off that, foregoing the married filing separate for the last couple of years of the student loans, it was better for them to get that adoption credit on the return. Okay. All right.
It'd be pretty high though.
What's that?
If you have a small student loan, does it even matter?
Again, I don't do that side of it. I don't do the side where, how your income affects what your student loan payments would be. There's so many rules out there now with, that debt forgiveness on those and your incomes and what you're doing and where you're working and all that stuff that, if you're a teacher and you're willing for 5 years after you graduate to work at an inner city or low income, sometimes they'll forgive your student loans.
So it's probably good to check both ways then.
Yeah, that's what I'm saying. Yep. So,
Even if it's a small one.
Yep. So, all right, number 6.
Okay, the maximum amount dollar limit for adoption benefits. What amount per child for 2017? $13,570.
Yep. Okay. Number 7.
The adoption credit totally phases out at what amount? D, $243,500.
Okay. And that's a pretty high phase out when you look at some of the other ones that we've looked at. Education credits are low to mid 100s. Child tax credit in 17 was that. So, all right, number 8.
A form that a taxpayer needs to complete to get the adoption credit is which form? D, Form 8839.
Okay, good. Number 9.
Which credit is not deducted from the tax liability before the adoption credit? D, the earned income credit.
And that is a refundable credit, right? Yep. So, okay.
Which of the following statements is false concerning the credit? The elderly and the disabled. D, it may not be available if both the taxpayer and the spouse are age 65 or older.
Yep. So, and then it's a Schedule R, and what's the R stand for? Pretty much, yeah. So that's the way I remember it. Yeah. Okay. So, yeah. So Schedule R. Yep. All right. And number 11. Jim? Yep.
Which of the following statements is false concerning the motor vehicle credits? B, plug-in electric drive motor vehicle credit is not available if the vehicle qualifies for the alternative motor vehicle.
Good. So that's your knowledge base on the alternative energy plug-in car thing. So, yeah, and again, we've seen just the last couple of years. I thought you would see this sooner, but just the last couple of years, I've started to see some of the energy credits. Like I said, one of them was just a letter with somebody that they didn't realize they could get it. So, but you don't see many of these. I just don't think they're. What's that?
I thought a lot of them were buying Prius.
Yeah, but this is a total electric.
Mhm.
Prius is
Oh, Prius is
Hybrid.
both. That's right.
Yeah, I don't think there's not enough to the car to do it. We're talking like the volts,
Yeah. and
or
one that most,
what is it?
Tesla.
Tesla,
I
yeah.
was gonna say Tesla.
Those are not cheap cars.
I know. But they're starting to see the electric charge stations around.
I thought
Yeah.
Volvo
There's a
was
mall
gonna
in
do it.
Easterview Mall in Rochester. Got a thing where you can-
Yep, that old, well, I think, is it Key Bank now? Key Bank in front of Eastern Hills Mall has some behind it, right by the Barnes and Noble, so.
Yeah.
But,
Of course.
yeah, I mean, you don't see enough of them. And like I said, it's an industry that at some point is got to get rid of the training wheels, because you look at this and you hear like Tesla and, what's the Tesla, they're the ones that have the factory down on the waterfront, right?
Yeah.
Volvo was doing it or
For the
something.
roof,
Doing
but,
it
yeah.
complete.
Yeah, but they were getting money from the government to come. And then you look at this and there's credit. So both sides of the equation, the consumer and the producer, both have subsidies and credit from the government. You don't see that very often.
They're both in positives.
Well,
One- one you
yes,
Take one and the other one has. a-
but if you slide one out or the government pulls out of the industry, what's going to happen to that industry? Yeah.
So it's self-sustained.
Can it? You don't know. Is that why they're doing it? Yes, it's great for the environment and the solar and stuff like that. It's we were talking about the amount of sun up here. Obviously, we only had one day this week, so your solar panels wouldn't be doing very good. But these solar farms, they lease this property and they put these solar farms out there. But my question is, yes, they are environmentally good, but what happens? What's the long-term effect on that soil? Or, is there cement pylons that are in there to support these things that have to be taken out? Is there,
What's the other-
has anybody found out what the impact on the soil is 20 years from now? So,
With that credit, you can only get it that 1 year.
Hmm.
So you really buy that vehicle thinking that you're gonna get a big credit?
well, it's like I said about
Or you're
the,
gonna be punished?
it's like I said about the people that are running around selling solar panels that tell you can get this huge credit.
Only for 1 year, right?
Well, but yes, and it's a non-refundable credit.
So it's gonna wipe it out and have to get a surplus.
I can think of 2 or 3 instances, and I can remember at the corporate office, even this past summer, where somebody came in and was like, "Hey, you messed up on my return." The guy I bought the solar panels from said that I was going to get a $5,000 credit. Where is it? Well, the one guy was retired, and his income was Social Security and a pension. He had no taxable income, so he had no tax bill.
Safe, yeah.
There was no, since it's non-refundable, there was nothing for the Pac-Man to eat. There was no tax bill. I mean, and that's a hard thing to explain because they're saying, no, he told me that I would get a $5,000 credit. Well, he did not lie.
Yeah.
But they don't know his tax situation. And, if it would have been a tax preparer selling the solar panels saying, hey, these are great. Your electric bill for the year is going to be $18, but you're not going to get the credit that they talk about because you have no taxable income. They don't know that. So they're not really lying, but they're just not disclosing the whole truth. So, and it's an instance where we emphasize and talk about on the radio and different stuff that, before you make any decision that has to do with your tax return, check with us. Because that's an instance where we would have said to them, yeah, that's a great credit, but you don't need it.
Yeah.
So, that extra $5,000 that you spent that you thought you were going to get back, it's kind of gone. And it's not going to come back. So, all right. Okay. So that gets us through a couple problems that we did. It gets us through chapter 7. All right. So we got the quiz done there on that. So we'll get ready for chapter 8, capital gains. Okay, we'll kind of go through a few things here, and then we'll get to we'll take a break. A lot of this chapter is very good to see in action in a return, because it starts to make a little bit more sense, because we can kind of manipulate some things. Because when you're kind of reading over, you're going, this is why I have a financial advisor, because I have no idea what this is talking about. Okay. All right. And that's where we always work together. You know, like I said, we have a great relationship with the financial guys. You know, they'll call us and, you know, they're talking to somebody that has some situation and about what it's going to happen, and vice versa. You know, they're a resource for us to say, okay, can you find out the value of this so that we know, so we can give them a good answer on capital gains. Okay.
Just a question on it. If you have stock or mutual in your 401k or IRA,
Mm-hmm.
you don't have to be concerned while it's there of any gains or losses as far as tax goes until you start taking it out.
Yeah, you know, that's where sometimes you get into, you hear that term of realized and unrealized. And, you know, sometimes you see on your little things, it says the dividend was reinvested. Some of those dividends that are reinvested, you go ahead and as you go along, you pay some capital gains on. So in theory, they think that you're paying little bites. So sometimes that dividend may show up as a realized dividend or capital gain, and it goes on your return and you pay tax on it, as opposed to waiting and paying on a big capital gain when you actually cash the stock at the end.
Even in the 401k?
Is
Sometimes, yes. You know, that's where sometimes you'll see that, you know, and again, that's, you know, it just depends on how the portfolio or whatever works. And then what happens at the end, though, because you've already paid tax on some of those dividends or capital gains, it raises your basis. So if I have what I bought it for, and then I have what I sell it for, the difference between the two is my capital gains. Now, along the way, there may have been same things where, you know, capital gains and stuff I had paid tax on, that raises my basis. And then I pay less capital gains when I sell it.
and will whoever will they know that or?
Yeah, they keep track of that.
Oh, okay.
Yeah,
So-
they keep track of that.
so you don't have to remember 30.
Well, but the thing is there, we have a lot of times, and this is, like I said, where the financial guys become invaluable to us, is that prior to the crash in 2008, when these portfolios were changing hands and things like that, they weren't really keeping very good track of the basis of the value of the stock when the person took ownership. And there's a lot of times that if somebody moves from one brokerage house to another, the information about what they paid for it doesn't make the transfer. So all of a sudden we have this proceeds, the sale of $100,000 in stock with no basis, zero. So by what it says on there, it would say that they pay capital gains on the whole 100,000. Well, that may not be true. And the brokerage house says, we have no idea. You call back to the previous one. We don't have those records any longer. So then you have to rely on the client to say, do you remember when you took ownership? And there's a website, if you want to write it down, it's called Big Charts. Let me show it to you real quick. That we use. Yahoo Finance is a good one, but it tends to have a lot of cookies that come down with it. Oops, I froze here. Oh.
Big chart and stuff?
Yep, Big Charts. Okay. It's just called Big Charts or marketwatch.com. What you can do with this, let me just do this. So, okay. With this, let's use Walmart. Okay. So I can see, let's see, Walmart. Oops. I have my Walmart there, okay? And I can see my symbol, let's see here, WMT. All right. So if okay. So I have this now, all right? I can do historical searches. See where it says historical quotes?
You can kind of go back, if you know,
Mhm.
at the time, you can go back and build.
Yep,
Put in the-
a little slow here.
Good.
Yeah, it becomes a headache, but you have to do it.
This
And
is where you keep your
yep,
paper.
so I'm doing a little historical thing, and I know Walmart's WMT from the symbol that may be on there. Remember that little 1099B I gave you? That's why I gave that to you. It has all the information. It might even have the stock symbol. But say that I want to look this up for Walmart. Let's see, my father passed 12/7/2001, and he left me stock that I took ownership of, okay? When I go to that, I can see that the price at that time was $55.34.
So that would be your-
That's my basis because that's when I took ownership. When it became my possession, the brokerage might have had no idea the basis, but that would be a determining basis that I took ownership when somebody passed and I was the inherited it or the beneficiary.
So when you take ownership, it's the date, not when he bought into it.
Exactly. Yep. Yep. But there are times with people that they sell stock they've had forever. I had one that somebody lived in the Midwest. I want to say it was Oklahoma. And she sold the stock and she'd had it for so long that nowhere along the way had any investment person. So she was actually kept very good records, called the utility that had changed hands and changed names 2 or 3 times. Somebody had record of it. She got a copy of it. It was something that must have been in the paper files somewhere out there because it was on an old Smith Corona type piece of paper, and you could see where they had made a mistake and something had wiped it out. So, you know, it was legit. You know, it wasn't like she just made this up on her computer on a spreadsheet. You know, it was legit, but that was the way we had to chase down the basis. Okay. All right. Okay. So capital gains. Again, almost everything people own and use for personal or investment purposes is classified as a capital asset. Your home, a car, household furnishings, jewelry, collectibles, stocks and bonds. The owner's basis in an asset is often either its cost to the owner or its fair market value. And sometimes we run into this when you're talking about a home, okay? Or some land or whatever. You know, if you can't figure out the basis, sometimes you have to go to fair market value. Capital gain results from selling a capital asset for more than the basis. All right. Capital asset is sold for a gain. That gain is generally taxable. You can do a loss, selling a capital asset for less than the basis. The loss from the sale of an investment or business property is deductible. Okay. All right. The loss from the sale of a personal use property, such a home or car, is not deductible. Okay. This is where people get a little confused when we talk about capital gains for their personal residence, and we'll talk about that. Okay. Capital gains can be either short-term or long-term. 1 year or less is short-term. A year or longer is long-term. Okay. All right. So what we're going to do is we're going to learn how to determine the basis of a property, talk about selling or trading investment property. We're going to talk about capital gain or loss when selling your home. And we're going to talk about how we report sales, exchanges, or other basis transactions, okay? Basis of the property. You probably started reading this chapter and this first thing you're reading, you're going, oh my goodness, what is this, okay? The basis of property is the amount invested in that property for tax purposes, okay? So we have the cost basis, all right? So if we think about a house, the cost basis is what we paid for it, okay? We have the adjusted basis. So again, we go back to the house. What happens if I put a new roof on? What did I do to its value? Okay, what if I paint the walls? Nothing. Okay, what if I did the siding? Okay, increases its value. What if I paint the siding? No. Okay, so you can see those things that would increase its market value. Okay, that's where your adjusted basis comes in. And then the basis, other, and cost, that's really one of those ones, like I said, we have to determine it. We have to figure it out, you know, that where it is, and that's where sometimes the fair market value will come into play. All right. Talks about cost basis. All right. Really, the cost basis is what you paid for it. Okay, whatever you paid for it. All right. And it talks about all the things on the different types of capital assets, what you can add to it. All right. You know, best example is the basis of real property includes settlement fees and closing costs. All right. Okay, so that's where when you have somebody that has investment property, it's not just the, you know, whatever the price was. And with basis on properties and stuff like that, always good for them to have that HUD-1 or that closing statement. Because, you know, if you've ever seen, you know, it's a piece of paper that doesn't fit in any of your filing cabinets at home because it's legal. So HUD-1, seller, buyer, talks about all the give and takes and all the different things that happen. So that's, you know, that's an ideal one, because sometimes when we're doing things like that with transactions, you know, you really need to see what was truly paid. So with the adjusted basis on that. Okay. All right. So we have that. Okay. So that's where basis comes in. All right. So that's the cost basis.
If you refinance, you have to pay closing costs again, do you get to add those?
Well, it depends. Can I add, am I really worried about the basis on my personal residence? If my home, then no. But yes, we want to keep track of it, because what happens if I pass, the house becomes my children's who do not use it as their residence, so then they're subject to capital gains. So anything that would affect the basis needs to be kept track of. And that's where I tell a lot of people, going back to the house, you know, if it's the case that somehow their name ends up on mom or dad's house and it's not their residence, make sure you talk to them and find out all the things they ever did to that house going back to 1951 when they bought it. Because I guarantee in 1951, they did not pay 2018 fair market value for it. So you have to really, you know, and that's where sometimes people, and make sure you talk to them, because you may have a parent that did a great job of keeping receipts and invoices and stuff like that. Carbon paper things sometimes don't do very well. And I know thermal receipts don't do very well when they're in the basement anywhere near the furnace. So carbon paper and thermal receipts, sometimes they say, oh yeah, we got that. I know there's a bank box downstairs, and they'll come up and they'll walk in and you know, that thermal receipt looks about like this, or it's all black because of the temperature. Okay.
Is that what you do?
You have to do your due diligence and your best possible. Okay. Because if you end up in a situation where the basis becomes mom or dad's, you better hope you have those adjustments, because like I said, you could have a situation where you're going back to a basis that is, to my knowledge, there's nothing in the tax code that adjusts the basis for inflation.
You can't go back and figure.
So, you know, if it'd be nice if you could have a index for inflation to adjust the basis in a situation like that.
So what does IRS do if they don't? Do they just figure out what the going rate was way back?
Unless they can,
1951?
well, unless they can find out documentation, that's what they're going to have to go. And that's sometimes where people are going to, I've sent them to the county clerk, and they go into the warehouse and pull out the Harry Potter spell books that are about yay tall and leather bound, and go through and, you know, hey, there, look at that. That's my great grandmother's handwriting when she was the clerk in town, because they're all written there in hand, and when the transaction took place, what it was sold for. So yeah, sometimes you really got to do some due diligence. Okay. Adjusted basis talks about increase the basis of property by all items properly adding to the capital expended, but not for appreciation. This includes, you know, things that you do that have a greater than a year useful life, that increase the value of the property, lengthen its life, adapt it to a new or different use. So again, you see that increase in our basis is things like that, okay? Decrease in basis. The only thing that I want you to do, and we'll talk about this a lot more later when we do businesses and especially rental properties, is depreciation, okay? Just know that decrease in basis, all right? Because you might sell your rental here, you bought it here, you increased by doing new windows and siding and roof and stuff, but in the meantime, you've been depreciating that basis. The government wants that back, so it lowers it, decreases that basis, okay? Because basically they're saying they gave you tax-free money all that time with depreciation, and now time to pay the piper, okay? All right, and then a basis other than cost. Again, you know, this is where things come in with fair market value and, you know, valuing it and stuff like that. But again, most of it is you have to find something to hang your hat on. You can't just sit there and say, you know, I can remember Christmas 1975 when Grandpa was talking about, you know, he got back from World War II and he bought the house for $10,000, and boy, that was a lot of money back then. Well, you know, yeah, that's great, and I'm glad you remembered the Christmas 1975, but, you know, we need something a little more to hang our hat on, okay? Great little chart here about increases and decreases to basis, okay? A lot of other stuff in there about basis, but there's a great little help box on 8.8. Says fair market value is the price at which the property would change hands between a willing buyer and a willing seller, neither of which is required to sell or buy, both of whom have a reasonable knowledge of all necessary facts. Okay?
Just snickering, being it's political season. The stock that Mr. Collins' relatives.
Yeah. Yep. Yep. So,
A little different.
well, you know, I guess they were willing buyers and willing sellers, but so. All right. Okay. So we have that. Some exercises there for you. Okay. Sale of investment property. Basically, you know, as it says there, investment property is property that produces investment income. Okay. It talks about some different things about disposal of investment property, includes sale, trade or exchange. We have a person that we work with that does what they call, yesterday was his big day because it was 10/31, Halloween. That's 10/31 is an exchange where people can take investment property, sell it, goes into kind of an intermediary, and then on the other side they buy something else so that it prevents from selling that investment property of having it be taxable because they're going to put it into another investment. So basically what that is kicking the can down the street for capital gains.
And October 31st is the deadline for it?
No, but October 31st was 10/31. The exchange tax law is called 10/31 exchange. So it was a big day for him yesterday. So, all right. So I thought that was pretty good that he picked up on that. You know, it's like 7-Eleven, you know, free Slurpee day on 7-Eleven. So it's always good that that's in the summer. All right. So it talks about that, how we would sell that. Again, we're going to talk about all this more in practice and see it in action. I am sorry to say that at the top of 8.11, throughout all your exercises, they show you this little IRS form called a 1099-B. All right? You will never, ever, ever see one of those when you do an actual tax return. Remember that thing that I gave you that was from a brokerage house? Yep. So I had, there's a gentleman I used to do that, a pastor, and he goes to somebody else now out in Akron that's there that's very good. But he used to come in and he'd just drop off his laptop because he was a day trader with Scott Trade. And if I printed out his 1099-B, because that's what he would do in his free time because he worked at the prison at Wendy. But if I printed it out, both sides on a PDF, it was probably 400 or 500 pages because of all the transactions. So he would just, and trust me, that would be a lot of 1099-Bs for every transaction. So, but you know, he just drop off the laptop and then I can go through it and do some summaries and I'll show you some shortcuts on stuff like that. You don't have to type in every line of a 1099B, believe it or not. So, but you do have to do it and we'll show you how that works. Okay. But again, this is kind of showing you what that 1099B would look like in the information. Again, they're going to be much more so that they're going to be that form that I gave you an example of when we were talking about dividends. Okay.
So if the end of every year, if you, like E-Trade or whatever, I'll necessarily send you, they'll have available to you all your transactions.
Mm-hmm. Like I said, those day traders and Scott Trade, and I haven't one of those guys that, again, I go back to 2008. I have a gentleman that's that way, and he has a portfolio that's worth several $1 million. And he took a hit with his day trades and, you know, kind of just took it. And he has capital losses carrying forward that he could probably pass for 3 generations in his family.
But it dies out when you die.
Mm-hmm. Yeah, that's what yeah, you know, obviously I told him that. So he says, is there any way I can try to use this up? And I said, I don't know. That's a lot. So, but all right. Before we take a break here, talks about amount realized and amount recognized. The amount realized from a sale or trade of property is everything received for the property minus the expenses of sale. Okay. Amount recognized, the gain or loss realized from a sale or exchange of property is usually a recognized gain or loss for tax purposes. Recognized gains must include in gross income. And again, this is where, you know, that unrealized, realized, things like that. A lot of times with investments, you'll be paying tax on capital gains, but you never had the money in your hand that year. It's not like they sent you a check for capital gains. It's realized capital gains inside your investments. And again, like I said, you pay tax on it as you go along and it adjusts your basis so that at the end it maybe minimizes when you do sell that. Okay. And yes, they do keep track of that, Jim. Don't worry, you're not losing out. So, okay. Talks a little bit about on the top of 813, what I was just talking about, like-kind exchanges. This is where, you know, somebody will take that investment property. I had a client, had 4 or 5 multi-unit rentals. His intention was that was going to be part of the inheritance to his kids, and they basically told him, we want nothing to do with that, okay? And he and his wife were ready to retire. They were from Rhode Island. Well, what they did is they worked with Russ Gullo that we have that does 1031 exchanges. They sold those, put it through the exchange, and bought a double in Newport, Rhode Island. So it's still investment property, like kind. And with what the transactions and the values and all that stuff was, you know, it probably saved them 70% of the capital gains that they would have had to pay if they would have just flat sold that rental.
So at the end of the year, do you get something that says a rollover?
No,
Would that be considered a rollover?
it's just a like kind exchange. Yeah. So, and on the software, we'll show you. And again, I'll show you this more so when we get to the rentals and on the Schedule E because it makes much more sense. Okay. What we're going to do most of this with capital gains right now is a lot of stock transactions.
So that exchange thing is like, if you lived here and then you have rental property, then you move there.
Mm-hmm.
I still have rental property, you would buy some out there and sell it here. And then
Yeah,
sell it here.
it has to be a little bit different. You can't buy first and then do the exchange. Basically, you have to sell. There's certain windows. That's why an intermediary, you have to use one because of all the little nuances in the 1031 exchange. But yeah, basically, if you lived here and had rentals here and you wanted to be in the same position, retired in Arizona, and didn't want to pay capital gains on what you had here, you'd sell this, but you have to have something on the other end.
Could be similar.
Like kind exchange, as they call it. So, okay. All right, let's take about 5 minutes. We'll take a break. When we come back, we're going to try to get into, all right.
And then we would have been asked.
There. All right, well, I am resuming recording, so we'll make sure. So, yep, cut and paste. All right, so back on capital gains, we talks about capital and non-capital assets, okay? Personal use property, again, you know, property held for personal use only rather than for investment is a capital asset, and any gain or from its sale must be reported as a capital gain. However, no deduction can be taken for a loss from selling personal use property, okay? And really what we'll talk about that is more so with your house. Talks about some things there with different inherited property and such, okay? Property used partly for business or rental. Again, we're going to come back to a lot more of this when we get into the Schedule C and Schedule E, because when we put depreciation in there and, you know, the percentage of business it's used for, you know, prime example is if somebody bought a computer for business, but they have it in their home and, you know, it's in the kitchen and they keep recipes on it. Okay. Well, I can't take that basis as a whole for just business because there's personal use on it. Okay.
Yeah.
Well, yeah, so that could be different things. So, all right. Okay. 817. This is one that we want to focus on in this section. It's the sale of your personal residence, okay? And how this works. Explains the rules in buying and selling your main home. As it says, in most cases, a main home is the one in which the taxpayer lives most of the time. If the taxpayer's main home was sold in 2017, they may be able to exclude from income any gain up to $250,000 for individual or $500,000 for joint, okay? And that is not, you know, that is any gain, okay? So what I'm saying is, if you bought a house as an individual for $250,000 and you sold it for $500,000, it's not the $500,000 for the single, it's that $250,000 gain that's excluded. Now, in Western New York, there's not a lot of $500,000 homes, okay? Prices are going up, but for most people that are married filing joint, that's a $500,000 gain. So they would have to buy a house for $750,000 and sell it for well over $1 million in order to run the risk of a capital gain. All right. And we'll talk about how that works, okay? We're going to talk about this form that you keep seeing pop up here and was in there from your reading, the 8949 on the Schedule Z. We're going to talk about that when we get into the problems. I want to show it to you a little bit better there because it's easier to follow. Because when you're talking short-term, long-term, basis, purported, not basis, when you're reading it, you're kind of going, well, wait a second. So yes, there are about 7 combinations with the 8949, but it's easier to see when you actually are doing a problem, okay? Data sale, obviously there's a transaction. Like I said, most of the time for me, I use that HUD-1, that closing statement, because that really gives me a good indication on everything. The main home can be any of the following, all right? So yes, Jim, that boat that you keep on Lake Erie that you live on, all right, that is considered your main residence, all right? So that's going to even be there. Okay. Let's see here. A lot of these are kind of situations that give you some things as to, you know, unique situations, and obviously somewhere along the line it happened and they had to make a decision on it, so that's why they're in here. At the bottom of 818, if the taxpayer, this is more than one home, if the taxpayer has more than one home, they can exclude gain only from the sale of their main home. Any gain from sale of any other home must be included as income, so there's no exclusion. So if they have 2 homes and they live in both of them, the main home is ordinarily the one they live in the most of the time, or probably in the state or the location where they have residency. So obviously, what's the example that they use and you see most often? Somebody has one here and somebody has one in Florida, okay? And, you know, with excluding that, you have to do it in the one that you live in most of the time. All right. And as legend has it, I've heard that auditors have done the tiebreaker by what is in the kitchen. Okay, I don't know if it's true or not, but this is always urban legend, that the tiebreaker was they looked at the house in New York and they looked at the house in Florida, and they said, the house in New York has more forks and silverware and dishes. You must spend more time here eating. So this must be your home. Because the place in Florida had one cup, one glass, one bowl, one fork, obviously was so. So keep track of your forks, Jim. Okay? All right. It talks about when they live, the things that the most important factor where they spend most of the time. There's some things here that these are things that make their main home. The address listed on their postal service address, their voter registration card. So if they come in to see you, Jim, next Tuesday, and their address on there is Florida, you gonna let them vote?
Nope.
Okay. You heard it right from the horse's mouth. We have a election monitor here that says nope. Federal and state tax returns. Obviously, if they're trying to get conducive or better situations, tax situations by where they say they live on their tax return, that would be their residence. And then obviously driver's license. Another thing they look at, home is near where they work, they bank, family members, and recreational or religious organizations. They're members of a church or members of a country club where they play golf. They might go look and say, you know what? You play golf here 7 months out of the year. That must be your residence. So you can see how they can kind of break that tie. All right. Okay. On the bottom of 819, a loss on the sale of a personal residence may not be deducted. I have a lot of people come in and say, but I sold my house for a loss just to get out of it. Well, nothing I can do. Because if they're going to exclude any gains, you think they're going to let you take the losses? No. Nope. Okay. All right.
They will for gambling, not on your own home.
Yeah. Yep. Talks about selling expenses and things like that. Okay. In order to exclude it, what are the rules as far as how long you live in it? Anybody remember from the reading?
2 out of 5.
2 out of 5. Okay. I ran into this with my mother. When my father passed, they lived in Colorado, and she chose to move back to the Midwest after he passed, and they had a patio home out there, and it was in an area of Colorado that there wasn't a real good market. So she had to start looking at this 2 of 5. She rented it for a while, okay, as far as renting it, but, to exclude the sale, there's portions that she had to do things with because of being rental, but excluding some of it when it's personal residence. She got to that 5th year and it wasn't sold. So all of a sudden we were out of the window of opportunity because in the past 5 years, the 2 years had passed. So she was in the 6th year and then all of a sudden it was only one of the last 5. So she kind of lost out on some things. We tried to sell it. It just wasn't, it just was no market for it. So. And then 3 years later, you go out there and they're building 10,000 more of them right around where she was at. So, all right. Reporting gains or losses. Here's where that whole 8949 that we're going to talk about comes in. We'll talk about that. That form 4797 for sales of business property. Again, going to come back to that when we see it in action. It ties into capital gains with the Schedule D, but it's much better to see it in action when we do transactions within the Schedule C and Schedule E with business, okay? All right. Talks about at the top of 824, the purpose of an 8949. Again, when you're reading this, it's hard to follow, okay? When I was reading through, getting ready for things, I'm going, boy, this just, you're starting to think, okay, I do a Schedule D and 8949, but then I have to determine is it short-term, long-term basis, no basis. Like I said, once we see it in action, it'll be much better, okay?
You're like a checklist?
Yeah. Yep, then I'll show you where that's at, okay? So again, you have some problems there. It shows you some of the forms. And again, don't get so hung up. I'd much rather from this chapter, I want you to walk away with the sale of stock or the sale of a residence, okay? Don't get hung up on that business property. We'll come back to that because I want to tie it in with depreciation and how that basis is adjusted when we sell it and where we do that. So don't, in this chapter, don't get hung up on the sale of business. I know there's a lot in here about it, but you know, much more of that comes in the later chapters when we start talking about Schedule C and E's, okay? At the top of 830, there's a great little thing that talks about Part 1, Part 2, short-term, long-term. This is the Schedule D, okay? These are where these things go in, but again, we're going to get in there on the Schedule D, and I'll show you, you know, once you see how easy it is on the computer, but I want you to understand, you know, how the basis is. The big thing I want you to do is you have to know how to get the basis to put it in there correctly, okay? Schedule Ds can be a little scary looking, but really they're not that hard, okay? All right. At the top of 833, my example of my friend that has a multi-million-dollar portfolio and took a huge hit in 2008, and he's been chipping away at it, 3,000 every year, okay? Unless he had, in 17, he did take a big bite out of it when the market was up so much because he was able to take some gains and use that loss because that loss carries over. And his loss is well into six figures that he's carrying over and getting to use 3,000 at a time. But even in 17, he didn't have enough gains to wipe out those losses.
But this was in real estate, and you have a huge loss that you're carrying over,
Uh-huh.
and you sell a property and you make a lot of money on that property, then you can just subtract it from that loss.
Yep, because
And
you're,
in addition, take an extra 3 off.
yeah, we'll show you, when I show you the Schedule D and how the carryover works, you can use a maximum on your 1040 of $3,000 is the way to think about it, but you can use greater than 3,000 when calculating your capital gains. So basically what I'm saying is on the Schedule D, before it goes to the 1040, on your Schedule D, if I have a $50,000 loss I'm carrying forward and I sell something for $55,000, and really 5,000, okay? And there may be some limitations based on things that happen on your return elsewhere that may limit how much of that 50,000 you can use because there's sometimes there's limitations. But basically what I'm saying is, no, you don't only get to use 3,000 against any gains each year. You can use all your losses if you have gains greater than what's on a carryover loss.
Oh, on that one, you'd have 5,000
As capital gains.
And then if you still had loss, you could use 3,000, so you could end up with 2,000.
Well, no, we wiped out the loss on that. We wiped out the loss on the gain was greater than what we had for total losses. Now, if I had a $50,000 loss, okay, and I sold something for $45,000, I'd have no gain to worry about. 5,000 loss still left over, but I can only use 3 of it and carry 2 to the next year. Okay, and like I said, when I do a Schedule D, I'll do some manipulation of the numbers, and we'll kind of see some of that. Okay, all right. So that's the big thing with the carryover. The thing to realize is that the 3,000 is all you can do. Okay. At the top of 835, it has a little capital gains tax rates for everything there.
Is that
Okay.
15 for 18?
A little bit. Some of the income ranges are a little bit. Okay. All right. So, and that's where, you know, Esther's been talking on the radio with a lot of people, especially at the end of 17, knowing what things were in place for 18 as to how and when they disposed of things. Because there were some things that, you know, was kind of great to bite the bullet and sit on it and wait till 18 to do it because the probably was going to be a more favorable capital gains situation. All right. So we have all that. Again, 836, you know, you got your little, and even the practice problems we're going to do, you got your nice little Scott trade and Shows everything there on that nice little 1099B. You're never going to see one of those, okay? Trust me, you'll never see one. Now, I take that back. My lady, I think she actually, the one she had, and I think back to the paperwork from the Oklahoma utility electric place, I think it did look like that. Again, it was hand typed on a Smith Corona, but you know, it did look like that. Okay. All right. Go to page 841, Marianne. Okay. But take a look at that for me. Okay. Remember you were asking where that number was coming from? Okay. Because what shows up there? Remember that 90,500?
Right,
That's their earned income on wages. What are those other incomes that they have?
interest,
Interest, is that earned or unearned?
that's unearned,
Okay, what about the dividends?
unearned.
State tax refund,
Well,
unearned, it's actually unearned.
you did earn it because you had to work to get that, get it back.
Well, not necessarily, because what if it was made up of refundable credits? All right, so that's where it becomes unearned. And then gambling winnings, unearned. So see how they subtracted everything out to get back to 90,000, because that calculation uses the earned income, not, if you go all the way to the bottom, well, it's not there, I'm sorry. It not the, 96 or whatever, the adjusted gross income. Okay, so see how that works on that one? Yeah, and that's why, you know, it says see instructions, but if you understand that line 3738 of the 1040 is adjusted gross income, and on that case, it's using taxable, which means you have to go back to this income section and back out any unearned income. And most of the time, where's earned income at? Line 7, unless they're self-employed. Okay? All right. Okay, so that gets us through chapter 8. Like I said, there's a lot in there about some of the business sides of it. Don't get hung up on that. What we're going to do is we're going to want to focus on this whole investment as far as the stocks. That's what you're going to see the most of. Okay, so what we're going to do is, let's see here, which one did I want to do? Because I don't want to do one that's going to make you work hard. Let's go in and I always like this one. Let's do Will Robinson. You're dating yourself, Jim, if you just said danger, danger, Will Robinson. What show was that?
Lost in Space.
Lost in Space. That's the show. Yes. Danger, danger, Will Robinson. So, all right. Did you see his email? Did you see his email? His email is robot@yahoo.com.
So somewhere that whoever's doing it, yeah.
It's got to be older? Okay. Is that what you're telling me? All right. So let's go in and so get into your tax-wise if you're not. Okay. In my case, it timed out on me. We're going to start a new one. So let's see. We got the bio for Will on 8/8. Okay. All right. And then we got some things. So go ahead and oops, get the main info in there. So nope, he's a single guy. He's traveling the
He was
world.
out in space.
Yeah, he is out in space. So
Can't be many girls out.
yeah, that's right. Oh, I can't remember. Is there still somewhere along the line? I think there's a Christopher Robbins problem too. I'm not sure. All right, being good grandparents and that wholesome stuff, you probably know who Christopher Robbins is. And Will lives just down the road here, Lockport Road. All right. I'm surprised he has a home phone. Being a space traveler, you'd think he'd just have the cell phone. Okay. And he works in delivery. And like we were just talking about, he is single, not married, no dependents. And he was a New York resident. Okay. Here's his bank account information. We're hoping that we can get a refund for him, so we'll put that in there for his direct deposit. And again, for PIN numbers, I just like to use their zip code since it's 5 digits. And we're going to say that he does not have a driver's license, even though he's doing delivery. Since we don't have his information here. All right. Okay. All right. So did everybody get the main info in there? Okay. All right. Okay. And then before we proceed, what we'll do is we'll go through the bullet points on 8.8, just so we get a lay of the land. Like I said, this is, you know, I like to do this on problems is have you get the main info in. And it's always good if you don't do it before you do it, just to read his little bio there, the interview notes. So on 8.8 says he filed a 1040A last year. So what's that tell you? He did not itemize. Okay. Talks about if he gets a refund, the direct deposit into a savings account. So make sure that we realize, yeah, got to pay attention. We have information for his 2017 return. We did a lot of that on the main info sheet. And Will has decided to see the world in an RV. Okay, so he sold his house for $133,000. He lived in the house for 14 years. Will paid $65,000 for the house. Will had brought receipts totaling $48,500 for capital improvements through the years. He had paid $3,500 in real estate taxes before the closing date. Okay, so what are we going to use from that?
65 plus the 4850.
Okay,
As we put into it.
all right.
It is closing costs.
Read it again, and I'm going to save you some work, Mary Ann.
He lived in the house for 14 years. 65,000 in the house.
Okay, back up. Hit reverse.
All right.
So he sold his house. What's the next sentence?
He lived in it for 14 years.
So we could stop right there. Why?
He's gonna get the exempts, the exemption.
Exclusion.
Gain, no gain on,
It's his personal residence that he lived in for 14. I would say that probably meets 2 of the 5.
Oh, so we're gonna find out he's not really owing.
He doesn't even have to talk about it.
Oh, okay, so you don't have to figure it out even though you know what the.
Exactly,
Oh, okay.
exactly. So that's why I said, you know, your wheels were turning right because you were saying, okay, well, 65, Jim's going over there going, all right, so 65, you put 48 in, we got to, you're doing it. Yep, I look over, Mary Ann's got the phone out, hits the calculator button. Okay, we got 65. She's starting to pound away on the numbers. But again, read it. And that was the intent, is why.
14.
yeah,
Because he lived in at 14, so that's meets that exclusion rule, 2 of 5. We look at the house, and really the only 2 numbers we'd have to worry about is sold and paid. You know, even right there, you subtract the difference. Is that greater than $250,000? No.
But if it was 400,000 he sold for,
Mm-hmm.
and he's single,
Mm-hmm.
now do we have to do all the calculations?
And then we would,
Okay.
because, you know, we met one of the first tests, but the second test would be the first 250. So then we'd have to, you know, start with the 65
you know, again, I always do this with, when I'm explaining capital gains. I don't know why, but I've just always done this. You know, we're starting here, this is here, okay? Bought it, sold it. Well, this is the number that we want to try to close the gap. So what are we going to do to it? He had 65. He increased the value by 48.5, okay? And he paid 3,500. Now, if he sells it for 400, that's greater than the 250. 250 of that is still excluded. It's not like it's a test to say that it's all. So if his capital gain on the house was $300,000, the first $250,000 is excluded. He only has to worry about 50 as capital gains.
He would be able to add the 3,500 real estate taxes?
Can he?
Well, if it brings that HUD and all that.
Can we add taxes? So which way does that do the basis? What happens on a closing with real estate taxes?
You have to pay back what they paid
Yeah, it depends on
when you close.
When,
the timing.
yeah. So that would be part of it?
So, okay, so if he paid these and it was really 10 months of next year, then.
It might be adjusted, yeah. So there's a lot of give and take. That's why I say HUD ones are so invaluable, because you start seeing them breaking down the property taxes to the day. You know, this person had 210 days, this person had 146 days.
Okay, that's right. It's only for that year. It doesn't.
Exactly. And the fun ones to figure out are the school taxes, because why? They follow the school year. They're always billed in October, and they lap over into another year. And for tax purposes, we're on a calendar year for cost basis, and we got to
We're still paying the next.
exactly. Yep.
So bottom line, the 3,500 needs to be added in
Mhm.
the cost base.
If we have to do capital gains, but again,
But I'm just saying, if we-
Western New York, you're just not going to see it. You know, there's not enough. The value of homes have not increased enough, nor is there a market where there's enough for those big ticket homes. So it's just going to be rare, unless, you know, you're hanging with the Pagulas or somebody else like that. So, well, yes, yeah, exactly, because
But it really has to be a lot of.
yeah, you know, that's where you might have to get in and talk about using a basis other than the adjusted basis or cost basis. Because just because you bought it below market value, you know, it might be the case that there may be some adjustments in there. So yeah, you'd have to really do due diligence on that. So
And your, for a house, your basis starts at what you paid for, like, there was one on Mountain Road that they had to move, and it was, they sold it for a lot less than they had when they built it.
Mhm.
So the new people that bought it, whatever.
that's
even
their
though it
basis.
was a loss to original owners, that's the basis.
Yep.
That he starts with.
Because IRS is going to get its money. Because if they're flippers and they bought it and they know that they can turn around and sell it because, you know, somebody was selling it for a loss and they're going to turn around and flip it and not have it as their primary residence, what are they going to pay a lot of? Capital gains, yeah. Because they don't get to go up to fair market. We know their basis because that's what they put into it. So the IRS is going to get it, isn't it? They're still going to get their share, even though somebody benefited by buying it below market value. Okay. All right. So that's that bullet point. Will sold some stock, and we have a 1099B. Okay. And while we're there, he had health insurance all year long. So we can clean up that ACA worksheet right now. Like I keep saying, we'll come back to a lot of stuff about the ACA when we get to chapter 16. But for right now, on income 2, or excuse me, on the 1040 page 1, we talked about he had a 1040A, so that little question in the box in the middle is a no because he did not itemize. Okay? All right, so on the top of 810 in the workbook, okay, go ahead and we'll put that W-2 in there for Will. Okay. Jim, did you see who he works for?
Lake speed delivery.
Yeah. Yep, go ahead and put that W-2 in there. And then once we have that all in there, that's when we're going to talk about the stock. Like I said, we'll be picking this one apart quite a bit. Making pretty good money working as working the delivery. He's being good. He's saving for his retirement. Again, always make sure that you calculate that retirement plan. Okay. One little nuance here that you probably have started to see a little bit in box 14 of his W-2, what shows up?
Disability.
Yeah. So in 14, really what you can do is type that right over that 414H for now. So we had New York State disability.
This one, line 12.
Box 14.
Oh, box 14.
Okay. All right. I want to throw your system off.
So when you put it in New York State,
Yeah, again, you know, New York State is very good about using the EIN number from the federal for the state down there at the bottom of the W-2. So for right now, you know, but always make sure you're conscious of it is different. But for right now, just get used to putting in the same EIN number. Okay. All right. And everybody's set with the W-2. I want you to go back to your 1040 page 1 for me, okay? So everybody got the W-2 in? See, you guys are getting good at this. All right, so 1040 page 1. We're going to go down. Obviously, all we've been talking about is income. And if we go to line 13, what do we see? Capital gain or loss. So we're going to go to our number on the right. We're going to hit F9. And what's in there? Schedule D. Okay. So hit OK for me on that. Okay. Now, I'm going to talk about this a little bit. Okay. Remember, what did I always say about the Schedule B? Interest and dividends go on the B, but they do not go on the B. So when you're in the computer, remember I said that there was always a worksheet for it. Okay. Same thing with the Schedule D. Capital gains goes on the Schedule D, but it does not go on the Schedule D. Okay. Jim's going, oh, great. Another one of those rules. Okay. Now, one thing I'm going to point out up here, and we'll talk about coming back to this, and I'll talk about it later. See this little line that says check here if you want to attach a substitute list. For the sake of time, when I was talking about my day trader and his, you know, PDF that was several hundred pages, I'll show you how to type it in. What you can do is you can print that, and then the way you enter it on the Schedule D and the 8949, you check that box, it prints paper, you staple it, and mail that to the IRS and let them sort it out. So basically, you print out his 1099-B, but I'm going to show you how to just put the summary in. And then all those individual transactions, thousands of them, you don't have to type in.
it's like see attached.
See attached. Yep. And you just mail it. Now, the funny thing is, this goes to a place here for the IRS and the return goes here. I don't know if they ever meet, but at least you know you sent it to where it's supposed to go. So what we have is Bob, our IT guy, we do these and staple them together, or some of them times you got to binder clip them because they're so thick. They may come in with this 1099-B, and it's even if it's 100 pages. But what we do is put this 8453, staple it on there. It's a cover sheet. You put the 1099-B, which is 50 pages long, and mail it off. And then I'll show you how to type it into the computer.
The IRS still gets it, it's just you don't have to,
You don't have to type every line. Last thing you want to do is sit there and type in 1,000 stock transactions.
they do get,
They get record of it. You're just kind of doing a summary. So,
and that's how they get it as paper?
yeah.
When do they
They
want
don't, I mean, they don't have to like send it, attach it.
You know, you can do it as a PDF attachment, but it kind of bogs down the e-filing system for us because of our volume of business, so we do it as the old-fashioned paper. And like I said, it goes to an address halfway across the country from where the return supposedly goes. So at some point they get together, so, okay?
You staple it and just send that, not with the return.
Nope. So, all right, so we have that. Okay, now, if you look at this, okay, actually, do me a favor, check the box for the 8453, okay? And what shows up on your tree on the left? 8453, and go take a look at it. Okay, basically, this is saying that this is, as Mary Ann called it, this is the C attached form, okay?
Mine didn't show up. Check here if you want to attach a substitute list.
8453? Populates over there. Okay, go back into that square. That's interesting. Okay, so go to add a form. Right, 8453.
Did it? Mine, yeah, mine did.
It did?
Well, Halloween goes through.
There you go. Okay, so now if you go down to the bottom of that. There you go. That's the box. Like that. Okay. Okay, so it's on there. Okay. All right.
So that's what it should have done, right?
It might not have done it. Did you do all the stuff for being a electronically filing and prepare at the front?
I may have not, because I wanted to.
Some forms won't populate if you don't have things on the main info sheet to say your e-file. Okay. So we have that, as you can see here, capital assets, it's saying see attached. But basically file this form only if you are attaching one or more of the following forms supporting documents. So basically we print this out, attach it to the 1099B and send it through the mail. Okay? And it'll print out for you. All right, electronically it goes in and tells the IRS, hey, more to follow. Okay? All right, let's go back to our Schedule D. So on our tree on the left, if you want to go back to your Schedule D there. All right, so we see that there's a Part 1 that says short term, and there's a Part 2 that says long term. Okay? All right, so we have all this. Then we see down there, it talks about 8949, box A, 8949, box B, 8949, box C, then the bottom, D, E, F, all this other stuff going on, carryovers, partnerships, K1s. Remember on dividends, we put that little thing in there. Sometimes we had capital gains on it for the dividends, stuff like that, okay? This is where it all flows to, but we never put anything on this, so you're never going to type on this. Okay, all right. What you're going to do is I want you to go to, see where it says short-term totals? Light that up and hit F9, okay?
Where,
Okay, so, right,
Oh,
short-term totals under the first column.
oh, first column?
Yep, probably was a yellow number. And what did we get?
Okay.
Should-
New capital gain worksheet.
Yep, so we got that capital gain worksheet. All right.
Like, sheet kind of for Schedule B.
Okay, and you can see why I say on there. Now, does it look like that when you popped it open?
yes.
Okay, now, what I want you to do, and I don't know why the software does this, and I'd love to ask the designer, when you get there, scroll up for me. Okay,
Well, we do know it's a short term.
well, but scroll up for me, okay? What's up there in red letters for you?
And then I come.
Yeah, and this is where that 10, the red column, so this will help us with what we do with on this, okay? Because what this does for us, those letters and what we put there will automatically generate the 8949. I want you to know that each one of these would be a separate 8949, okay? But we don't have to try to create that and sort through that.
That's really the problem there we get. You know, each box, you check the different boxes and add it to a whole other.
Okay, so this is where, you know, this is gonna help us generate the correct 8949. Instead of saying, okay, well, I have to do an 8949 that's short-term basic, you know what I mean? Okay, and then we'll see how that works, all right?
Okay.
Now, on this, if you look at, this is really making it clean, isn't it? Okay? My description of my property, okay? In this case, Jim, you're gonna love this one. Did you see what he sold? 250 shares. Do you know what MPIE stands for?
No.
Little trivia for you. He had shares in Moon Pies.
Moon pie, oh yeah, I love
Will
moon
Robinson.
pies. I love moon pies.
Do you know where?
PIE.
A little trivia for you. Do you know where moon pies were invented? I'll give you a clue. It's the birthplace of my father.
Kansas? Kansas?
Ottawa, Iowa. And at the time, during the 1950s, it had the widest main street in the country.
Really?
But that's where moon pies were invented, was Ottawa, Iowa. Population, I think it peaked one time at about 3,200 people. But that's really their only industry there. They still make moon
That's all they
pies.
did then.
The widest main street and moon pies. So, okay?
Oh, well, 'cause you know, for a while, Lockport had the widest bridge in the world.
Mhm. Yeah.
The widest road, the red.
Yeah. See all this trivia? But yeah, I thought you'd like the moon pie one. So.
Yeah.
Anyway, so we're gonna put the description of property here. Okay, so we're gonna take in there. And his description of his property is, we're gonna write, it's abbreviated, that's their stock symbol. But we're gonna put moon pie in there, okay? Nope, don't have to worry about the number of shares, that's just kind of for record, and we'll explain why when you do other ones, okay? Because say if I didn't have the cost basis, what would I do? I'd go to big charts, look up moon pies for 1952 or whatever they bought them, or 2005. So say that box 1E had the cost basis was not in there. What would I have to know?
What do you want?
Price per share and then multiply it. So that 250 shares, that's why that's on there, okay? Now, here we're gonna use our 1099 column, all right? He bought them in 2005 and sold them in 2017. What does that make it?
Long term.
Okay, and do we have the basis reported to us?
Yeah.
Okay, so let's go up to our little code thing at the top. So we're gonna go down the bottom three. So it's long-term, and it was on a 1099B with the basis reported. So what letter is that? A D, okay? What populated on your tree on the left when you put the D in there?
$89.49.
Yep, that says 2D.
2D.
And it's long term, okay? So now we've created, see how it creates the 8949? Like I said, from the reading, I want you to understand that you have to do that. That's the correct filing. And all this came around from the crash in 2008, being very specific on this. Because like I said, it used to be, he just kind of did a Schedule E and he said, I bought this, sold this, there it is. They, you know, the whole long-term, short-term thing was not really a component, okay? So we have that. TSJ, we talked about all the different things on there, okay? All right. Now, date acquired, he bought them when? 2/14/2005, yep. Okay. And he sold them on my birthday, March 11th. You'd think that I wrote this problem, huh? Okay. Are you beginning to wonder if I wrote this problem, Jim?
Yeah.
Okay. I guess that's kind of my type of humor, huh? All right. So we have that. Okay. Now, if we look on the far right, see that S/L column? What did it tell us? Long term. Okay. Long term. All right. We sold it for $2,500. Okay. And our basis was $250. Okay.
So what's that show us?
Basically, it was 250 shares. 250 shares.
No, but look at 1E. So,
Sale.
but on the 1099B, see, it shows that his cost basis was $250. So we had it. Yep, we had it. What I'm saying with the 250 shares is if we didn't have that, we'd have to go look up on that date that he bought them and find the share. And that's where, like I said, I showed you the big charts. And we have to calculate. So sometimes they don't report it and you have to go look for it. Yes, they are. Well, they've been around a long time. So he made what? A gain of $2,250 on that. Okay. Again, we look back on our tree and stuff like that. We see that the 8949 is all set for us. All right. Now let's go to our Schedule D, page 1. All right. And as we scroll down there, not short term, but as we look down at the bottom in part 2, yep, they're all filled in for us. Okay. All right. See how that worked? Okay. So like I said, it's just like the Schedule B. Get to that worksheet because everything's on there for you. All right. Now, let's go back to the capital gain worksheet.
On this, at the bottom on 15, that spouse's long-term gain is where my 2250 is. Today, not
As, where are you talking about?
line 15.
And that long term?
Mine's got spouse's long-term.
When you were doing the capital gain worksheet, did you throw something in that TSJ? Yeah, because if you coded it TS or J, taxpayer, spouse, or joint, did you put a code in there? The column right after the 1099, the red 1099?
So leave it blank.
Yeah, you can leave, or you can do it.
Or you put T,
But again,
taxpayer,
taxpayer, this would be a taxpayer.
You know, like,
Okay,
spouse, or joint.
okay. All right, okay. Now, here's what we're gonna do next, okay? So we kind of saw how things floated around on that. All right, okay. All right. And with his capital gains and the fact he's not withholding and things like that, how's our blue box look, our refund monitor?
I can't get, when I go to get rid of the, I put S in that column,
Uh-huh.
it won't let me delete it. It says calculated.
Oh, you're on the 8949. Go back to your capital gains worksheet.
On the worksheet.
Go back to your worksheet
Oh,
and get rid of it there. Remember, if it's yellow, you can't do anything to it. If it's green, you can do it. Okay? Green numbers you can manipulate or modify, I should say. Manipulate's not a good word in the tax way. You can modify, okay? All right, now, we are back on this, and you can see how it flowed to different things, correct? Okay? And what'd you say, Mary Ann? What happened up there in his blue box?
He owes a lot.
He owes a lot of money, doesn't he? Okay? Good thing he sold his house for a profit. So he can pay his tax bill before he takes off in his RV. All right? Okay, so now we're going to do a couple things, okay? If you want to put it in the what if mode, you can. All right? Because if you want to save it, that's pretty much the problem, but we're going to do some things because I want to show you some things with the Schedule D, okay? Now, on this problem, all right, we're going to say that being the savvy investor that he is, he decided to buy some shares in Klondike bars because he seems to be doing well with the frozen sandwich.
How do you do the what if again? To file and now?
File then to what if, yep.
I did that, but I'm getting a Schedule D form. Oh, I see that.
Yep, so go back to your capital gains worksheet where we put it in, okay?
Worksheet, would be worksheet 2 then.
Nope, capital gains worksheet, go all the way down, you'll see it, it says cap GN,
Oh, caption.
yep, below your 8,000s, yep.
So I'll still be on my what if stuff?
Yeah, say your what if,
I got my green on the side.
yep, you got the green on the side, but going to this, okay. So he bought some shares in Klondike, okay? All right, and they were short term. So, and we know the basis, so we're going to put A. Okay. All right. On this one, in the last year, he bought a bunch of on different dates. Okay. So as opposed to typing in a bunch of different dates, I just want you to hit the letter V. And what fills in there, and the date acquired.
Just the letter V?
Yep.
V-A-R-I-O-U-S, various.
Okay, see how that works? All right. And he sold them on the March 11th. So put 03112107, okay? So even though it says various, doesn't really give us a thing, because we coded it A, what shows up in the far right column? Short term, okay? All right. Okay. He bought these shares for $1,000, or excuse me, he sold these shares for $1,000, okay? But he paid $5,000 for them. See, you know,
Kind of offsets, you know.
okay?
Will, you're not.
All right. So he has a $4,000 loss, doesn't he?
I'm not going to-
Okay. So he lost $4,000 there. All right. Okay. So what happened on the tree on the left? We see the other 8949. See how it made another one for us?
short term.
Yep, did a short term. Okay. And, you know, if you click on those, Jim already went to it and he was trying to modify, but it shows the stock on there. Okay.
On the short term, it'll show.
Yeah, if you go over to the 8949, it'll show up there. What I want you to do is go to your Schedule D, page 1. Okay. Okay. So we have the $4,000 loss in the short term. We have the $2,250 gain in the long term. All right. Okay. So let's go to our, you see where that all calculates out and carries over? Let's go to our 1040 page 1. And if we go down to line 13, what shows up there? So 1040 page 1, line 13,
Negative.
Negative 17%.
because we had a $4,000 loss and such, so we went back and forth on that. Okay. All right. So see how that kind of works on there with those. Okay. Now, go back to our capital gain worksheet again. Okay. So it's right after the 8,000s. Okay. All right. And Klondike actually is going out of business. So it was a fire sale on the stock. Okay. So actually his cost basis was $10,000. Okay. So go on that same line, go over there to the cost basis. Put 10,000 in there. Okay. So he has a $9,000 loss on his Klondike bars. Moon pies are a much better investment. Okay. So with that $9,000 loss, let's go back to our Schedule D, page 1. Okay. And what do we see there? $9,000 loss short term, $2,250 gain long term. Okay, so we see that. Let's go to the 1040 page 1. And when we get there, what do we see?
3,000.
Okay, because why? Only do 3. Okay, exactly. Okay, all right. Now go to your tree on the left. All right. Okay. And if we go to, you can see Schedule D Worksheet 2. See that there under Schedule D? It's kind of indented a little bit. Yep. So you go to that.
We're still on the what ifs though, right?
Mm-hmm. Yep. Okay. What's it show calculated there? What's it show?
Probably ends up being the 3,000 loss.
Yeah. Yep. But what's it show for a carryover?
37.50.
Yeah. So that's what's going to be carried over to next year. All right.
So then if it's a new client next year, we would like them to bring in their tax returns so we can see that.
If
And
I've,
we would have put that little message in there.
yep. Yep. Because we'd have to see their Schedule D to see what they have for carryover losses if it's a new client.
Usually do people have their tax returns?
our receptionist, and anytime anybody's making an appointment, especially during tax season, to alleviate the back and forth, you know, if they're a new client,
They had a flood and they don't have it, they don't physically have it, or they misplaced it.
then they would, prior to them coming in, we'd probably do it or ask them to do it, is go on to the irs.gov and get a return transcript, or go back to their previous accountant. They would need the previous accountant one if there's capital loss, because the transcript's not going to show that. So, okay.
And what button do you hit again to put the note in? Like,
The diary,
yeah,
hit F7. And what we were just talking about earlier about chasing down capital gains. And we got Will Robinson here,
F7?
F7, yep. And it gets that gray box like you see up there in the center, F7.
Yeah.
Are you in the what if mode?
What if,
Yeah, probably doesn't go up there. But if you look on my screen up there, I hit F7, this comes over. This might be a good thing to say on the middle of it. Say that Klondike bar basis, oops, Klondike bar stock, if I could type, stock basis from big charts website. Okay, so they know where you got the basis, because if something should ever come up that's they're questioning how you determine the basis, at least whoever has to address it would know where you got the basis.
do you put the note also that there's a carryover in there?
Nope, that'll put that automatically in there. Because if they come back next year, the carryover will be in there. Okay, if you go back to the Schedule D page 1,
Should still in what if mode, or should you?
yeah, you can stay in the what if mode. That's fine. Okay,
Where am I going again?
Schedule D page 1. Okay. What did we know that the carryover loss was for him?
30-something.
3750, because we saw the return. Marianne was asking if we saw the return. So if I go here and I'm a new client, see where that short-term loss carryover is? I'm allowed to enter something, correct? Because it's green. I can put, seeing from his other return, I can put his 3750 loss that I saw in the previous return. If it was a returning client, that 3750 would already be in there. I'm looking at line 6.
But then it comes out to be 12,000.
Well, I'm just using this as a what if scenario. So basically what I'm saying is, you know, I got his return and I saw, because it didn't show up, there was a 0 there, but I have his previous year's return that did show a 3750 loss. So I am putting it on this return, and that's where I do that. All right. But how much of a loss is he going to get to use? 3,000. Okay. I could, you know, I don't care if this says 150,000. Okay. I go to the 1040 page 1, 3,000.
The only difference is it's got a bigger carryover.
Yeah. And that's why I say, for some people, you know, my client I referred to, he's well into 6 digits.
Any, not that it matters, you know, it's like what line you put into that 3,000 number or reason?
I think you could have left, wipe it all out, get rid of it, and you're starting fresh.
Yeah, it makes investment people be a little more savvy, because you know, what do you hear? A lot of people when they come in, they'll say, well, I sold some losers to offset my winners. Well, what are they doing? They're manipulating their capital gains on their 1099-B, not on here. But you know, you would hope that your investor would say, hey, remember we sold all those losers last year? We got that loss on the return. We can sell some winners and we're fine. You know, you would hope that your financial planner is savvy enough to do that. So, okay. All right. So that is
How do we get out of the RF1? We just go back in F1.
the what if. Yep. Yep. Go up to file.
And then just get back in R1 and get out.
Mhm.
Can we get out of it now?
Yep.
How do you just go back?
And do you want to replace it? We want to say no.
Yep. So go up to file.
Yeah.
Click on what if again.
Oh,
And
okay.
then it asks you to make sure you do no. You don't override it.
Oh, okay. I don't lose my work.
So you don't lose,
Yeah.
exactly.
Mhm. Okay. All right, so his loss was, the answer on that one, the loss, or excuse me, loss. His federal balance due is 4231. And his state, he had a loss of 871, if you want to write that down, okay?
The roof came up, putting a damper on his cross-country trip.
Well, like I said, good thing he sold the house and had that profit that he doesn't have to claim. All right?
He's only cheap.
So, I mean, I realized, and I did a little bit of a what if, but that kind of gives you a little scenario what goes on in there, okay? All right. Okay. All right. Okay. All right.
Just, I know he's going on maybe, but if he continued lifting, would he, the next year, because he owes so much, if he didn't adjust, would they say you need to have numbers more than
Yes. Because if you take a look at his, the 2210, we'll talk about this with tax balance due, but if you go to his 1040 page 2 and you go down to line 78, you see his balance due. What makes up part of that balance due? What's on line 79?
Oh, it's, okay, estimated tax penalty.
Yeah, so that 4231 includes an $82 because he did not pay his taxes timely. Okay, that's the term the IRS likes to use. All right.
But it's something that they have to use, like, you got a big raise that year or something that didn't change anything. I mean, normally, like, if you're working along or change, you might change jobs or
Mm-hmm.
something. Have it.
All right. Okay, let's see. Who was the preparer last time? Jim?
Yeah.
All right, you get to pick on Mary Ann this time. Okay.
No, but then-
All right. Before I forget, homework. Let's see what chapter we're going to be reading. Chapter 9. We're going to get into some retirement. Okay. So we'll be reading chapter 9 and the exercises and the quiz on 8, and then do the problems in 8. There's some other stock transactions and such. Okay. All right. Okay. So we'll stop that.